Welcome to the Opening Bell Report.
Today we are strapping in for, well, a high-velocity exploration into a sector that sounds straight out of a sci-fi novel, ocean AI. And specifically, we are diving deep into the tech and, let's be honest, the volatility around Nauticus Robotics. The ticker is KITT.
And this deep dive feels really necessary right now because the market action around KITT has been nothing short of explosive. It's forcing everyone to reevaluate what this company actually is.
Exactly. Our source material today is this highly bullish contrarian analysis report that dropped right after the stock saw a massive and I think unexpected 13% surge.
And that one move was enough for it to reclaim a really critical psychological level.
Right, closing the day right at $1.01. I mean, that close feels less like a stock price and more like a regulatory cliff edge that they just managed to avoid.
That $1 on close is the immediate catalyst for sure. It's what draws us to the material. This stock has been, just beaten down for months, so any sudden aggressive move like that, it demands an immediate look.
So the core question we need to unpack for you is pretty high stakes. Was this surge just a classic dead cat bounce after a painful decline? Or have we stumbled onto a golden opportunity in this heavily beaten down AI stock?
And the analysis we're looking at isn't shy about it.
Not at all. It's suggesting a potential 150% upside from this current level.
So our mission today is to really synthesize this report. We need to understand the granular details behind the arguments for and against this as a high-risk speculation play.
With a focus on that central tension, right? The really exciting futuristic tech narrative they're selling.
Versus the stark, immediate financial reality that is, currently hanging over the company.
Okay, let's unpack this right away. The analysis is adamant that you should not view KITT as some slow, heavy industrial services provider.
No, the entire bull case rests on positioning them as a pure tech play that just happens to operate in the ocean.
You're trying to shift the market's perspective away from, like, CapEx-heavy machinery.
Cranes, barges, that kind of thing.
Right, and move it towards specialized, scalable software. They want the valuation multiple of a SaaS company, not some marine industrial contractor.
So if we strip away that old industrial label, what exactly is the core technology driving this whole story?
Well, Nauticus builds autonomous robots. They call them aquanauts.
And this is way beyond what people might think of as a normal ROV, a remotely operated vehicle. The kind that's tethered to a ship with a guy controlling it with a joystick.
Totally different. Aquanauts are designed to be self-driving, intelligent marine robots. They function with true autonomy.
And that autonomy is all driven by their own IP. The brain of the whole thing is a cloud-based AI software platform called Tool ITT.
Right, and this platform is what manages the complex missions. It lets the robots operate by themselves for long periods. And crucially, it allows them to reduce or even eliminate the need for those huge, expensive, human-crewed vessels on site.
And what's fascinating here is just the sheer size of the problem they're trying to solve. I mean, traditional offshore operations think inspecting massive offshore wind farms or maintaining deep-sea oil and gas pipes.
Or even complex naval defense stuff.
Exactly. It's all profoundly expensive. We are talking hundreds of thousands of dollars a day just to charter a big vessel and its crew.
That's the financial driver. But the analysis also really leans into the environmental driver.
Oh, absolutely. Those large crewed vessels are also just massive consumers of fuel. They generate significant carbon emissions.
So the core narrative, the one that's so compelling for long-term investors, is that KITT is offering a solution focused on really radical cost reduction and cutting that carbon footprint.
By replacing these large carbon-heavy operations with compact battery-powered autonomous robotics, KITT is aiming to disrupt a multi-billion-dollar market that is just, ripe for an efficiency upgrade. It's a powerful story.
The powerful long-term story, if the technology can actually scale successfully.
And that's the big if.
To put that potential scale and the current struggle into perspective, we're talking about a company trying to disrupt a massive industry. But KITT itself is a true microcap right now.
And that's the pivot. This potential game-changing technology is housed in a company with a current valuation of only about, $28 million.
Which is just wild. To put that $28 million microcap valuation in perspective, that's less than the average luxury yacht that some of their target customers might own.
Let alone the specialized deep-water vessels they're hoping to replace.
And that low valuation brings us right to the central contradiction the whole bullish analysis hinges on. The report basically says investors have a shot to buy a disruptive robotics and AI company at this rock-bottom price because the market is completely focused on their shaky balance sheet.
Ignoring the potential long-term value of the tech.
Exactly.
Well, this raises the important question then. What specifically is scaring the market away so badly? Why are they willing to ignore a potentially revolutionary AI platform?
The analysis is crystal clear on this. The company is experiencing a serious cash crunch, and it has significant debt.
And that's the high-risk element. This is not a safe bet.
No. That financial vulnerability, it introduces the risk of severe dilution or even, insolvency if they can't commercialize the tech fast enough to stabilize the books.
And commercialization takes time, but that debt deadline does not wait.
This is where we need to really look at how the report frames it. The analysts label this situation an asymmetric risk play. They argue the potential upside is 2x, maybe 3x, while the downside is capped.
Right, so let's explain that for anyone new to this kind of speculation. What does asymmetric risk really mean here?
It just means the potential reward is way bigger than the potential loss. The analysts argue that if the company fails, if they can't navigate the cash crunch and go bankrupt, the downside for the shareholder is capped. You lose your investment, it goes to zero.
But if they survive, if they land a big contract or a financing lifeline, the potential return is massive.
Okay, but wait, we have to push back on that framing a little. If they have debt and a cash crunch, that downside risk isn't just a simple zero.
I mean, survival itself could be painful.
Right, if they try to survive through financing, severe dilution is almost a certainty. That could wipe out a huge chunk of current shareholder value, even if they stay solvent. How does the analysis justify that aggressive, just zero risk assessment?
That's the gamble. The report does acknowledge the high risk of dilution, but it suggests the current super low price already factors in a high probability of financial distress. The real asymmetry, they argue, comes from the short-term market mechanics we're about to get into.
Squeeze potential.
Exactly. If the company gets even slightly good news, the short sellers who are trapped in the stock could ignite a really volatile move up, regardless of the balance sheet risk. It's a calculated gamble on technical momentum and just survival.
So let's dig into that fuse, the thing that actually lit this recent 13% spike. Because the tech story is long-term, but this recent move was purely technical, driven by market mechanics.
And this stock has all the ingredients for a momentum-driven move, specifically a short squeeze setup. The analysis gives some pretty eyebrow-raising numbers.
Okay, let's nail those numbers down and define the terms. We're looking at a very tight structure here. The total public float, so the shares actually available for trading, is only 13 million shares.
Which is a tiny pool of supply.
A tiny pool. Now, look at this short interest. It's sitting at around 18% of that float.
That is high.
It's incredibly high. It means nearly 1 in 5 shares available to trade are being bet against by traders who think the price is going to keep falling.
When you have that many short positions crammed into such a small float, any significant move up can trigger panic buying. The shorts just rush to cover their positions.
And the analysis noted that a volume spike, like the 13% gain we just saw, it immediately makes that big group of trap shorts very nervous.
No.
They're worried about covering before the price moves even higher against them.
That 13% move is basically proof of concept. It shows the stock can move dramatically on low volume. It's like the sound of the fuse being lit, and that's what gets institutional interest in the momentum play.
And the numbers that back up the potential reward here are, well, they're dramatic. The analyst consensus price target cited in the report is sitting all the way up at $2.50.
So if you do the math on that against the $1.01 close, you are looking at a potential upside of over 140%.
That is a massive gap that short sellers would be trying to outrun if the momentum continues.
And that high ceiling is precisely why the report frames this not just as a rebound, but as a potential multi-bagger, a stock that could multiply in value several times over.
If that short momentum holds and the company can gain some genuine commercial traction.
Right, a lot of ifs. So now, let's ground the psychology of this recent move in some technical analysis. Let's explain why that $1.01 close matters so much beyond just the headline percentage gain.
Okay, so the stock had been absolutely hammered before this. The floor, the all-time low it recently hit, was a gut-wrenching 69 cents. It had a very steep climb just to get back to $1.
And that's why that $1.01 close is described as psychological gold. For institutional money managers, for retail traders, reclaiming that $1 threshold is critically important.
It suggests a bottom might be in.
It does, and it shifts the whole market sentiment from death spiral to possible turnaround.
And beyond the psychology, there's a really vital practical reason this matters, especially for these microcap stocks.
A delisting fear.
The delisting fear. Reclaiming and holding that $1 level removes the immediate looming threat of NASDAQ regulatory delisting warnings.
That fear alone keeps a lot of conservative retail traders away. They just won't touch a stock while that delisting clock is ticking.
So clearing that hurdle, it acts as a major signal, a de-risking signal, really to bring fresh momentum money back into the stock. And you need that for any kind of sustained rally or short squeeze.
So if the momentum buyers are coming back, what are the key technical hurdles they have to get over next?
The analysis identifies specific resistance levels that anyone interested needs to be watching right now. The first hurdle is immediately at $1 a cent. That was the highest price it hit. during that recent spike.
And if it fails there,
The momentum move might just be over, short-lived. But if it clears that first immediate resistance,
then the next barrier zone is set between $1.20 and $1.30. And if the stock can sustain movement above that zone, that would indicate a real structural shift. It would prove new buyers are coming in at higher prices.
and that move would potentially validate the start of the bigger sustained short squeeze narrative the report is hinting at. Until then, we're just watching high-risk speculative trading.
So what does this all mean for you? We've distilled the core attention here. You have the undeniable promise of KITT's groundbreaking ocean AI technology
Those autonomous aquanauts, the tool KITT software,
versus the immediate, undeniable, very high-risk financial challenges. The cash crunch, the debt load, the very things that scared the market away in the first place.
and if we connect this to the bigger picture, the analysis makes it clear this isn't an investment based on current fundamentals.
Yeah.
It is a high-volatility speculation play.
Driven entirely by the hope that the exponential long-term value of the AI will ultimately overcome the very real, immediate financial risks of being a debt-laden microcap.
The question remains right. Is the AI promise a life raft for the company? Or is the cash crunch a hole that's going to sink even the best technology? It's really a bet on the future of maritime automation itself.
Exactly. And that leaves us with a final provocative thought built right on the claims in the source material. If this company, not a KISS or maybe a competitor who can successfully scale this tech, if they succeed, just think about how fundamentally offshore operations will change. Defense, energy, transport.
Everything.
What happens when autonomous AI replaces human crewed vessels and labor entirely? What does the complete silent automation of the ocean floor actually look like?
That's the billion-dollar question that this little $28 million company is trying to answer right now. Something to ponder as you watch that $1.06 resistance level.
Don't forget to like, share, and subscribe for more.